Here's what you're able to do before the year ends to lower your taxes. Here's what you're able to do after the year ends. Okay, most people want to come after year end, and I have to tell them, you gotta pray, right? And I would hate for that to be you. So let's go over 10 different deductions you could take in your business. But I want you to keep this in mind. Deductions are great and all, but they are never a dollar for dollar reduction on your taxes. They're only a dollar for dollar reduction on your income. And of course, I have an illustration. All right, so let's assume this. We have a $5,000 deduction on one side and a $5,000 tax credit on the other side, all right? So same value, but different impact. And we keep everything else the exact same. So gross income of $100,000. Then we'll take out our deductions. These are all your write-offs. You may hear them being called, okay? It's just all the expenses of your business, really. And then you get your taxable income. As you can see on the credit side, there is no deductions because we're saying we have no expenses necessarily. We just have credits. Assuming a tax rate of 24%. And again, this is like not accurate. This is just to make the picture a little bit more clearer, okay? So the taxes that are due on the deduction side is almost $23,000, okay? Versus $24,000. So right now, the deductions are looking kind of good, right? But now we layer in our $5,000 credit. Okay, so what you end up owing in taxes after everything is all said and done is about $23,000 of taxes if you are using deductions and $19,000 if you're using credits. So honestly, we would really want credits. Deductions are way easier to get, to be quite frank. Here are some of the credits you can be eligible for. You can take a look at the list and see, it's a little intense, okay? So let's just talk deductions in this video. This is what is on the menu. Let's eat. All right, so if I happen to catch you after year end, you still have a little bit of luck. We can use retirement contributions to save you some money in taxes. So in this tax deduction, you're literally paying your future self and you get to get tax written off because of it, right? So it's a win-win. You can fund your IRA or a 401k up until you file taxes, even if you ask for an extension, right? So you can basically use money that you put into this year to help reduce last year's taxes. This is pretty much the only thing you can do after year end to reduce your taxes. Basically, the way it works is that with your 401k and IRA, if you fund these retirement accounts, then the IRS basically removes that from the income that they can tax. So in this example, we're assuming that the person has $200,000 of income. For the solo 401k, as of the year I'm recording this, the max contribution is $69,000, okay? And if you have a SEP IRA, then the max is 25% of your income. So in this case, if we have, let's say, $200,000 worth of income, 25% of that would be $50,000. So this one varies a bit. So I don't want to bore you with the boring stuff, but just keep in mind that when you are self-employed, you are basically the employee and the employer. So if you have a solo 401k, you're able to contribute as an employee and an employer. So you can really maximize how much money you can tuck in here. So let's get to the good stuff, right? How much money can you actually save with this? Again, assuming that the income was $200,000, it would be a tax savings of $17,000 if you have a solo 401k and $12,000, or let's call it $13,000 if you have a SEP IRA. This is what you need to do to be eligible for either the SEP IRA or the solo 401k. So it doesn't really require much to be eligible. And if you're able to tuck away a lot of your income in retirement, congratulations, you're avoiding elderly poverty. Okay, we don't want to be old and broke. All right, moving on to S-Corp elections. Shameless plug. Everything that I'm talking about in this video, I can help you with. If you need tax strategy, definitely book a call in my description and let's hop on the phone. I think this is what people hear a lot about, especially if you're a small business and you're starting to, get a little bit of money. So the S-Corp is a tax election, and I'm going to have a deep dive on S-Corp, so definitely make sure you are subscribed. But it basically makes your company more official in my eyes. So you go from self-employment, which makes you the employee and the employer, to having an S-Corp, which makes you the employee and the owner. Those two people get paid differently. As an employee, you are on payroll, so you have to pay payroll taxes, which is basically your Social Security and Medicare. So if you do not have an S-Corp election, you are paying 15.3% on every single dollar that you are able to keep in your business. If you are an S-Corp, you will still get paid as an employee. So you still get that 15.3%, but only on a smaller piece of your income. The other piece gets paid as a distribution or a dividend, you may hear. And because that's a distribution and not necessarily wages, you don't have to pay payroll taxes on that money. And I have a chart. This, I had to pull out Google Sheets with you guys because this is a lot of information, okay? Again, I'm going to be breaking this down in great detail because this deserves its own dedicated video. We're gonna assume that this business had a net income of $100,000 as an LLC, and then versus when they elected to be an S Corp. So same net income. As an LLC only, without the S Corp election, all this $100,000 has to be subject to that self-employment tax, that Social Security and the Medicare/Medicaid. So that's what you see right here. And it's a little less than 15.3%, but just stick with me, trust me, I will dive deeper in another video. But the point is, if you are an S Corp, $35,000 of your $100,000 doesn't have to get this self-employment tax, right? So they're empty here. We could just jump straight down to our federal taxes. And that ends up being a savings of almost $9,000 on somebody making $100,000 net income. Typically, if you're netting about $50,000, you should definitely look into this. But if you're for sure netting $100,000, you are leaving money on the table. So if you're looking for someone to do this for you, I would love to earn your business. Book a call in the bio. Imagine what you can do with an extra $9,000, right? You can reinvest back into the business, or you can go on a nice trip. We don't want to deprive ourselves. We're going into this risk of having a business. You deserve a vacation, right? You deserve something nice. I would not want my business to run my life. I would want my life to run my business, okay? All right, moving on. Hire your children. This could be a little bit dicey because there are labor laws, but when you have your own business, the laws work a little bit differently. You can hire your children. What's nice about hiring your kids is if they're under 18, they don't have to pay those payroll taxes. And also, if you pay them under the standard deduction, which is basically some money the IRS just throws at you and says, hey, you might have made $100,000, but we're gonna just take off $13,000 just in case you had to get health issues or whatever you're gonna complain about. Here goes $13K, right? They don't even look at $13,000 that you've made as taxable. And this amount changes every single year. But if you pay your children under that, this money is completely tax-free. And the children can gift you that money. I think it's up to $17,000 or $18,000 right now. And that is also tax-free. So this is a crazy tax loophole, okay? The IRS will eat this up. So you have to make sure that whatever you're paying them is reasonable. You can't just try to tuck in like $20,000, $30,000 in there because they have a lower tax bracket, for example. Is that work actually worth $30,000? If you were to go hire somebody else, what would you pay them? All right, moving on to one that I think is a little bit of a surprise for some people, but your education. Yes, education shouldn't stop after school, but you can also get a tax deduction for it, okay? So once again, this is a win-win. You can go to conferences, you can go to networking events, even buying books, subscribing to magazines, YouTube Premium, right? Because your competition's on there. There's a whole bunch of information on here. I can keep on going, but the facts are there are plenty of things you should be doing to educate yourself or even get around people in your industry, and they are tax deductible. Even if it's not in your state, if you're traveling to go to a conference, you can deduct the airfare, okay, the hotel. Now we're gonna start to get a little bit more technical, so just buckle up. So there's cash basis accounting and there's accrual accounting. Cash basis is basically where you don't see anything in your business unless they are talking cash money, okay? So if somebody said they're gonna pay you, but they haven't actually paid you, you don't recognize the transaction until the money is in your possession or right on its way. Accrual accounting would say, well, once I've earned that money, whether they paid me or not, that money is mine. I count that as revenue. So the benefit about doing cash accounting is if you are in a situation, especially if you're an influencer, let's say, and you may go into a contract and you may perform your services and they don't pay you for 60 days. And that happened in December. If you're cash basis and you get that money in January, well, guess what? That's next year's problem, okay? So you don't actually record that and you don't pay taxes on that. Now, somebody might think, well, what would be the purpose of going to accrual-based accounting? Why would I want to pay taxes on money that I have not even earned yet? You can also have expenses that you did not pay for yet also reduce your taxable income. You can have a supplier that you don't have to pay for 60 days, but you can still pretend that you paid that technically with the accrual method because you do owe that money. So if you're somebody who gets a whole bunch of sales maybe in Q4, right, October through December, but you don't actually get that money until next year, this may help you if you're in a situation where you have an abundant year and you're looking for ways to reduce your taxes. Now, you can't just go bouncing back and forth between these methods, so there are nuances. But this is a way for you to kind of defer your income or pull some expenses forward, depending on how you actually record your transactions. Let's go on to purchasing equipment, all right? You guys, I had a computer that was so bad because my child had stepped all over it. I would pray for it to open when I would go to work, okay? It was time for me to purchase some equipment, big time. So if that's you and you are dragging your feet about investing in something, but you had a really good year, now is the time to invest in that. There are tax codes that actually let you write off quite a lot of money, okay? Up to like over $1 million worth of depreciation all in 1 year. And there's bonus depreciation that is also phasing out. So at least at the time of this recording, by 2027, we're not gonna have these benefits. So you definitely would wanna bring forward any investments you've been dragging your feet on. And on the topic of buying things, you can also reclassify some expenses. So maybe you did buy something and you're, depreciating it over time. Bring that forward. Again, you can't just do this all willy-nilly, but if you have some capital expenses that probably really should have been operating expenses, you can get with your accountant, have them look it over and see what they can do. What about harvesting tax losses, okay? Crypto burned me so bad 1 year, or did it? Right? I also had a good year, thankfully, in other avenues because I wasn't the crypto investor I thought I was. But I was able to write off up to $3,000 worth of crypto losses against my ordinary income. So this is perfect if you have an S Corp, an LLC, where your taxes from your business flows through your personal, because you can use those personal losses to offset other income that you've earned. Now, again, there are caveats, okay? If you had any gains, well, we're gonna apply the losses to offset those gains first. Then it can offset other income. Now with this, people can get creative, okay? So the IRS says you cannot buy the same stock 30 days before or 30 days after you decide to use those stocks against your other losses. They're trying to prevent you from being able to take advantage of any quick drops in prices. All right, QBI optimization. You just getting 20% off of your taxable income just because you're a business, right? I love it here. This is specifically for small businesses. It does phase out after a certain income limit, but keep in mind that everything that we've spoken about, you can pretty much use to reduce your income to qualify for this QBI deduction. Now, if you have a special service whether you're an accountant or a lawyer or something like this, you may not be eligible. There are a whole bunch of loopholes with this QBI, but basically, if you stay clear of those specialty services, you may be eligible for this. All right, so if any of these pique your interest and you wanna make sure that you're eligible, let's have a chat. I have more information in my bio. You can book a call with me and we'll just get on Zoom and talk about what your options are. Otherwise, I wanna see you in my next video, so make sure you subscribe and hit that bell.